The crypto industry has been facing a tumultuous and fragile path in the face of U.S. regulations and the repeated actions of the Securities and Exchange Commission, SEC, against digital asset trading platforms. The SEC, responsible for maintaining transparency in financial markets, regulating publicly traded companies, brokers, dealers, and exchanges, and monitoring compliance with federal laws. The SEC has filed numerous lawsuits against cryptocurrency companies over the years, and seems to be adopting an increasingly obstructive approach towards the industry. The SEC's latest approach to regulating cryptocurrencies is a result of a series of lawsuits filed against companies like Ripple Labs, Kick Interactive, and BitConnect, among others, accusing them of selling digital assets in violation of federal law. Many in the industry believe that the SEC's approach is not providing workable conditions, or at least a clear path to follow, which may force trading platforms to comply without registering with the SEC. However, for the SEC and its president Gary Gensler, cryptocurrencies are unregistered securities, and the crypto industry does not want to listen to the rules, which would mean cutting profits. The SEC considers all cryptocurrencies as securities, and it is possible that the entire sector may have to adhere to the agency's point of view. However, the worst-case scenario could be that centralized exchanges, CEXs, may only be allowed to trade Bitcoin, the only token considered a commodity. The difference between a commodity and a security is indicated by goods that can be bought and sold, or financial instruments that represent ownership of an entity, such as a company or mutual fund. Commodities are physical goods that have intrinsic value, while securities are financial instruments that meet certain basic requirements for investment. There are some specific tests that can be used to determine if an investment is considered a security under U.S. federal laws. The main test, which has been cited multiple times by the SEC, is the Howey test, named after a related U.S. Supreme Court case from 1946. The Howey test is based on 4 elements. 1. Is there an investment of money? 2. Is the investment in a common enterprise? 3. Is profit derived from the efforts of others? 4. Does the investor expect a return on their investment? If the answer to all of these questions is yes, then the investment may be considered a security under the law. However, the final determination should depend on the evaluation of specific facts of each case, and it is on this ambiguity that the SEC's regulatory action towards cryptocurrencies is being played out. Cryptocurrencies that could fall under the definition of security are those that meet the 4 elements of the Howey test. This includes initial coin offerings, ICOs, and cryptocurrencies that are centralized, meaning they have a controlling entity that can alter the token's supply, algorithm, or network protocol, such as Ripple's XRP, which the SEC has identified as an unregistered security. The SEC's regulatory action towards cryptocurrencies has far-reaching consequences not only for U.S. companies but also for the global crypto sector. Companies in the industry have to navigate the regulatory minefield, and many are looking to move their operations outside of the U.S. to avoid being caught in the SEC's crosshairs. Coinbase, the largest exchange in the U.S., has considered moving its headquarters outside the U.S. unless there is a change in the country's approach to regulating cryptocurrencies. The conflict and chaos surrounding crypto and security are expected to continue until the SEC and the crypto industry can find a middle ground. The crypto industry is lobbying for clearer regulations that do not stifle innovation and growth, while the SEC wants to protect investors from fraud and promote transparency in financial markets. Finding a balance between these two objectives is crucial to the growth and development of the crypto industry.